Hey, Casey Snow here, Director of Paid Media at Easton Digital. Today we're going to talk about what should my ROAS goal be. So there are many routes we can go down here, and I'm going to kind of show you an example of a financial analysis and how we kind of think about ROAS and what that can lead to. Now, there's also a conversation about blended ROAS or MER, depending on how you want to look at it. Those are technically different, and how those are always changing in terms of what your goal should be as you grow and scale, because there's actually an inverse correlation of when you scale, you don't just sustain the same goal because your costs of the business are changing as you scale. So is your overhead. Your overhead doesn't scale as fast as the rest of the variable costs in the business. So that's stuff we'll go over, but we'll kind of give you a baseline of where to get started and how to think about it. And then we'll have a separate video on, what does it look like when you scale? So I'm going to share my screen and show you an example of financial analysis we run. There are multiple sheets on here, but we're just going to stick to this first page. So you can kind of see we have our AOV, 90-day LTV, weighted average profit margin, which I'll get to in here in a second, shipping costs, credit card fees, and then your break even on first purchase and what's your break even on a 90-day LTV, lifetime value. So we have these multiple scenarios here, and this can get very complex, and this is even a basic version. There are a lot of people out there that have a lot more robust or even prettier versions of what this is, but the concepts hold true on how you should look at this. So what we want to do first is we want to identify that you have variable costs in the business and you have fixed costs in the business. And we need to identify what those are and be able to put them in this sheet so then we can calculate at what spend and at what revenue from that spend are you breaking even, and then after what point are you then making profit? Because for most of the companies, you are, you don't have private equity, a bunch of funds in the bank. You are bootstrapped. You are funding your own business and its growth. So to do that, you have to make money to be able to fund that growth. It has to come from the profits of the business. And to do that, if you are doing a lot of paid media, Google ads, Meta ads, TikTok ads, you need to have an understanding of, as a business, where do we need to be and at what point are we profiting? And then you can work on forecasting, all of that. You can see we have forecasting down here. We have some business metrics we track month to month here, and then your margin. So I am going to, actually I lied. I'm going to jump over here. This is a super, super basic example of, all right, if I have product one and it has 70% margin, I need to calculate, let's just say in a year, what percentage of my sales come from product one, and it's 10%. Because if we were to sell, only 10% of our high margin products, but then 80% of our 50% margin products, our blended margin won't be the same because we're selling a lot more of the lower margin than we are the higher margin. But if we take into consideration the percentage of sales a year for each of those products, then we can give it a weight of, all right, well, it's 70%, but that's only 10% of sales. So we're not giving as much weight to the 70% because it doesn't sell as much. So then that gives us a weighted blended margin. That's going to contribute to your variable costs. And that's kind of what we're trying to figure out here is we'll have our variable cost here. We'll pull in your shipping cost, your credit card fees, and that's going to be our template for variable cost. From there, we're also going to insert overhead later, as you can see here. So you fill this out, you figure out what your weighted average profit margin is, kind of figure out what does it cost to ship out an order on average to the business. Maybe you're making money, so then you actually have a negative number here, and then your credit card fees. So this is, like I said, about the average cost to the business for an order and shipping cost. From here, we have scenarios built out, and this is something you can do, or you can save this, replicate it, make a copy of it, whatever. But what you do here is, all right, at 10K spend, at $100 AOV, and these are all fake numbers, by the way, this business needs a 2.15 to break even on just variable costs. That's the only thing considered in this scenario. So, and which is these costs right here. So on variable costs, this company at 10K spend needs a 2.15 to break even. You can see profit is 0. From there, it's like that's just part of the scenario. If you were to only go off of that, what about all the overhead of the business? You're not taking that consideration of what you need to be profitable. Obviously, you're paying your overhead every month. You need that to be profitable. You need to cover that and you pay it. So we enter that into the equation now as well. So now you have your fixed costs, which won't scale at the same rate as your variable costs will, because when orders go up, these costs go up. Your overhead should not. Now, that's not 100% true 100% of the time. There'll be little things here and there. You also have some software that you have on your Shopify store, your WooCommerce store, and they go up in cost when orders go up. So it's not 100% true, but it'll get you the idea where you need to be. From there, once you include the variable cost and then your fixed cost, you recalculate that, say, all right, at that same spend of 10K, where do I need to be? I need, with $100 AOV staying the same here, I need to generate this much, which is a 6.45 MER, or blended ROAS if you're only doing paid advertising. That's what I need to break even to cover overhead, ad spend, which is variable cost, and all your cost of goods, shipping, and credit card fees. So if I'm covering all my costs, that's what I need. That's the goal of the business, at least, at the very, very least, to start making money. So your goal needs to be above that if you want to be making money. So that is how we think about it. Down here is a scenario where we've built in, like, all right, well, if you want to build in a 10% profit goal, then we can calculate that in as well. And then we'll be able to figure out, all right, then the 8.2 is where I need to be to meet our goal of profitability. So there's, again, a lot of things you can do here. This can be a lot more complex, but this is the basic thought process of, I need to figure out what my fixed costs are, what are my variable costs, and then based off of our ad spend, what does that need to be to break even, and then figure out from there what you want your goal to be. So, and then this is kind of a teaser to a next video. It'll be like, you'll notice at 30K, that break even goal changes quite a bit from 6.45 to 3.58. That's because this cost doesn't change. Only your variable cost does. So the more you scale, the closer it's going to get to that 2.15. So again, that's for a different video, but that is the basic way to think about it. It's important that you know these numbers for your business, and because that's going to be the foundation of what your goals should be when you're advertising. And then you could start forecasting out, well, during busier seasons, we're going to be spending more. We're going to be spending more. We'll probably have a lower ROAS goal that we'll need to break even. So we can be more aggressive. We know, especially if there's increased competition that time, and we're going to be spending more, that we can bid more aggressively because we don't need the same goal. We don't need that 6x. We need a 3x now. So there's a lot that can play into it. Playing the strategy helps forecast inventory when you get to that point and you have that structure built out. So that's how we think about it. It's going to be different for every business. Depends on what your AOVs are, the cost of your business, cost of goods, overhead. Need to figure that out, build that foundation, so then you know what your ROAS goal needs to be. That is a long-winded way of saying it depends, which we think is a pillar of Easton Digital, because there's a lot of things. Every business is unique. We can take concepts and plays and all these things we've done or we've ran before, but we have to tweak them to every business. And so that's the idea of it depends. That's our pillar, one of our pillars. So I hope that helps kind of get your brain going and thinking about where you need to be for ROAS, or MER as the end goal, I like to say. And MER is marketing efficiency ratio. It is essentially the difference between that and blended ROAS, for those wondering, is blended ROAS is all kind of paid focused, where MER is if you had influencer marketing built in there, and that's not necessarily paid advertising, but you still paying influencers as a part of your marketing cost to get awareness and sales. So that goes into your MER calculation, because you won't just be taking ad spend, then you'll be taking the cost for the influencers, and then looking at total sales, which that's what MER is, by the way. It's your sales over your total marketing spend. That's the idea. And blended ROAS will just be your paid media spend, Facebook, Google, TikTok, whatever you're on, over how much sales you generated. That's your blended ROAS. So hope that helps. Let us know if you would like us to run this for you. We're happy to help walk through this, help calculate it for you. It is important, very important for your strategy, how you manage cash flow in the business, how you manage paid media to determine what your goal is, so you can make sure you're working on your bottom line, your contribution margin, your profits. So, because that's what's most important to the business. Casey from Easton Digital, and let us know if you need our help on building your financial forecast.